Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Biddle and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Hope you're trying to stay connected with this property market, which doesn't seem to stop amazing me. I've been at this for a little while now, and even some of the dynamics I'm seeing, some of the nuances around this market, I sometimes got to scratch my head and go, where is it all going to go? And I think everyone's asking those questions themselves, trying to make sense of it all. How do you actually operate in this complex market? And let's be fair, property's always been complicated, complex. There's a lot of moving parts. I'm a big sort of proponent of the thesis that property should be simple, property investment should be simple, and it is also simple. There's just a lot of moving parts to it. What I find and chatting with people is that those that can demystify property and make property simple for property investors are the ones you probably want to be listening to. We're very fortunate in Australia that we have people who are invested in supporting Australian investors, a lot of buyers agents out there who try and demystify and make it simple for people. You don't want to overcomplicate it. And if you don't understand something in property, guess what? You probably want to walk away from it. Or if someone is deliberately making something sound complicated, making things sound secretive, making things sound like it's unique and it's a completely different proposition, put a big question mark around it. So keep it simple, but understand the complexity. And I really want to get into that today as a point of discussion. We have rapidly rising prices. No doubt everyone's sitting there when there's an advert comes on the television for those that watch free-to-air TV now. I've been watching SAS Australia lately. I normally flick onto realestate.com.au and go, what's going on? So prices rocketing, interest rates, a lot of noise around it, what's APRA doing, serviceability is changing. All these different factors are making some investors a bit jittery. So just wanted to give some sense to it all. Joining me in the studio, Lachlan Biddle. He's the director of Atlas Property Group, semi-regular guest. Lachlan, how are you going?
Good, Phil. How are you?
Good, mate. What are you seeing in the market right now? This sort of preamble there around, what's going on. You're dealing with this stuff every single day, mate. Does it make you nervous? How are you keeping a hold of it all?
I think complex is probably the best word to describe it, and not necessarily in a bad way. I think just more in the sense that, I don't know, if we go back 12 months ago, COVID, all that sort of stuff, like there was a few things going on, but on the whole, everyone felt pretty good. Prices were starting to grow, but they weren't anywhere near what they're at now. There was definitely no noise around interest rates. And everyone sort of was really confident in investing. I think there was an investor survey, and it was something like 75% or 80% of people said that now is the best time to be investing in property. And that was 12 months ago. But now it's obviously just becoming a little bit more complex, a lot more noise, like you said. So there's a bit to sort of go through and unpack it, I think.
Well, I've got a secret for everyone. You heard it here first. The best time to invest in property is now. And fast forward a year's time, the best time to invest in property is now. If you can afford to invest in property at any given time and you're buying the right assets for the right purpose within your means, now's the time to invest in property. Don't try and pick the market. Obviously, be aware of and maneuver within the market. However, just get going, just do it, but make sure you're doing the right stuff. And to give some sense of it all, Lachlan, prices are sort of continuing their astronomical rise right across the nation. You've got to remember also some markets move faster than others, some markets not as fast. Some markets faster than the median. The median is the middle. What do you think is causing this continual increase in prices, and is it going to be sustainable, mate?
Great question. And I thought for our chat today, I brought some data. I got it up on my screen here. So
very cool. I love data.
Yeah, I thought, and you know what? Everyone always, listeners, they always say, love it when people get in and actually talk about some data, give some numbers around it. So I think from my hand and what I'm seeing and doing, being somebody who does like data and analyzing it, I've sort of got maybe 6 or 7 things that I think are really, contributing to it. So the first one, and I mean, look, realistically, all of it to me actually comes down to supply and demand. If we just sum it up into one sort of concept, it's supply and demand. But there's obviously a few different elements of that. So for me, the first thing, listings, they're low. They've been low for ages. They're starting to come back through, but they're low. I think the last numbers I saw was something like 26, 27% below 5-year averages, which is huge. It's so hard to find property, and I think a lot of people can empathize with that.
Yeah, and I've been chatting a lot about it. We're in this sort of spring selling season now. Like anecdotally, and this is sort of what I'm hearing on a daily, weekly sort of basis, there's a lot more stock coming onto the market. Do you think with that happening, it's just going to be absorbing the demand out there, or when is this sort of supply and demand equation going to change so it puts less positive pressure on price growth into 2022?
Well, it's a really good question, because that actually takes me to my second point, and that's absolutely listings and stock. It is coming on. I think maybe 3 months ago it was like 30% below 5-year averages. Now it's down to about 26%. So there's more coming on. But sales volumes, it's up 42% over the last 12 months, and it's up over 50% on 5-year averages. So even though there's stock coming back on, and even though there is a bit of a lack of stock, what is there is getting snapped up as quick as you possibly can do it. So it's hard, right? Not enough stock. Everyone wants it, and the numbers show that.
Do you reckon this is propagating panic buying? People who are just maybe sort of moving outside of what they would typically consider smart buying and just, been knocked down 10 times, missed at auction, frustrated, got money burning a hole in their pocket, and they're just going, stuff it. I'm just going to pay it now. I've had enough. I'm done with it all. I just want to get in. How do you sort of temper that approach, Lachlan?
I 100% think that's what's going on in some places. And I think investors, because, we're all in here to make money, make a good investment, see something that rises over the next whatever period you want to attach to it. Investors are a little bit more tempered in that. Owner occupiers are certainly feeling that. And particularly, like, think about the situation where you've got a young family, they've outgrown their home, they're desperate to move on. Exactly like you said, they've missed out in a few different places. They are now getting really, really, really desperate, right? So they'd rather go, we'll find another 50, 100, 150K if they can, obviously. But if they've got it there, we'll throw that to get into it. Fortunately, I think investors, they take a little bit more of a, like I said, a tempered approach. But I'm still seeing it from investors. And I think it can be really dangerous if you don't know what you're doing.
And do you think most people now know what they're doing? I imagine your client base, you're sort of saying, let's not panic buy, even though they probably apply pressure to you going, it just doesn't matter, just do it. Let's not worry about it. I just want to get in. How do you manage those expectations, Lachlan?
Honestly, I think a healthy dose of pragmatism. Like I'm saying to clients all the time, depending on what they might be looking for or things like that, this isn't something that we might necessarily be able to find tomorrow. Like, of course, there's stock out there, but to find good stuff in this sort of environment, it can sometimes take a little bit of time. What might have been a week or two might be now 3 or 4, or it could be 5 or 6. But I think that there are still a lot of investors who are wanting to make sure they jump on this train of growth. And, whether we see the 20, 25% growth we've seen this year repeat, percent for percent next year, who knows? But there's still going to be something out there, that's for sure. And I think a lot of people want to jump on that. But I'm seeing some crazy things happening in the market. Like I had a property shown to me very recently by one agent, and it was on a cul-de-sac street. There was another one running parallel right behind it. There was 2 properties that sold in that street within the last 6 to 8 weeks. Those properties were over 100 square meters bigger. One of them had an extra bedroom. Both had some element of renovations done. And this property listing that I was being shown wanted me to pay the same price as them. And I turned around and said, you're crazy. Like, there's no renovations. One of them was 130 square meters less land. And it's literally over the back fence. You can't possibly tell me that is reasonable. And this agent said people will pay it, and I said, you know what, that is true. Somebody will come and pay it, but for me and for investors, not a good idea.
That's it. You leave that purchase some other mug. But What's also fueling this is the whole idea of panic buying. Through the COVID pandemic, people have got a few more bucks in their back pocket, which is a good thing. Savings are through the roof. This is pent up demand. I think people's views towards how they want to be working and where they want to be living is changing. People sort of seeking more lifestyle-orientated assets, which is changing the property market fundamentally. You got to remember also, we can't get carried away thinking that everyone's going to be working from home because, only certain jobs lend itself to working from home. People still need to be somewhere doing their job. So it's got to be tempered, but things are changing. I think it's sort of 5% of people sort of had flexible working conditions. I think moving forward, it's going to be 15 to 20%. So that's a huge bit of the market. That will change property markets. But a big part also is the fact that interest rates are at record low, which is a structural thing done by the government. I want to have a chat about that, Lachlan. We'll just go to a break. Stay with us, back in a moment.
Do you want to achieve wealth and passive income through property investing? PK Gupta helps a community of over 10,000 investors achieve passive income by buying top 5% growth and simultaneously positive cash flow property using data, without wasting months doing research, spending weekends at inspections, or dropping $15,000 on buyer's agents each time. So, if you're overwhelmed with information overload but don't want to drop $15,000 on buyer's agents each time, check out PK's website, consultingbypk.com.au, and learn to build passive income through data.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Lachlan Biddle, who's director of the Atlas Property Group. Now, there's a whole bunch of people out there trying to buy property at the moment, Lachlan. More stocks coming on the market, but it still hasn't tempered the sales activity and or the speed of growth in property. Put it into context also, the borders have been locked up for 20 plus months. So we haven't even really had the migrant population, which is the fuel of this nation, driving jobs and growth. That's been locked up. We've had some expats come back and they've generally come back with a few shekels in their back pocket. They've been buying up some good property. That's been a driver. But all of this sort of wrapped up is the fact that money's been the cheapest it's been for a considerable period of time, if not ever. And that's been a fuel also for a lot of people being in the market. But is cheap money going to be around forever? A newsflash, rates will go up at some point. It's just a matter of when. The RBA has been pretty specific, saying, you know what, we're going to let it go for a moment. We need to stimulate economic growth and rebound. And structurally, they're going to probably let that fly. But we now know that APRA's involved. They're trying to put structural changes into the banks, so they change serviceability. And there is a potential change in the RBA cash rate. Any expectations on when that will happen? I think they said 2024, but you reckon it's going to happen earlier?
I think it will. I think almost all economists have probably revised their predictions to being at the very least mid to late 23, but I'm even seeing some people say early 23. So for those people out there who don't like looking at their calendar and realize we're almost at the end of 2021, that could be only 12 or 14 months away if some of these people are correct. But the inflation stats came out for the September quarter a couple of weeks back, and there was a big song and dance about it because we moved into the target band of that 3% range. But I don't know what your thoughts are on it, Phil, but when I looked into it and went a little deeper, it actually didn't concern me too much. I mean, if for people who don't maybe know how inflation's calculated, basically the ABS goes and gets buckets of different items. And I think last time there was like 80 different categories of items or something. And they basically just benchmark that price. And then they use that and they weight it and they do, lots of fun finance things, and they spit out a number, and each category or each group ends up having a number assigned to it. And with this big tick up in inflation, it was really driven by only two out of I think it's 11 groups of items. And that was housing and fuel. Everything else was really low, like sub 1% in growth. But fuel, I think, was like 7 or 12% or something like that. And housing was, like around 5 to 7 as well. So those two really helped push that number up and make it look possibly a bit healthier than it really is.
Yeah, I'm not an economist. I don't proclaim to be one. I'm just a humble podcaster. However, where you look at inflation, i.e. stuff more expensive today than what it was a year ago, you talk about fuel and you talk about housing. Yes, housing is a lot more expensive, and we've spoken about some of the reasons that's fueled that growth, but also building new housing is a lot more expensive because building materials are a lot more expensive, and a lot of building materials aren't made in Australia. They come from overseas, so therefore shipping is more expensive, and all this COVID stuff has has potentially, but probably artificially increased the cost of construction for the moment. It probably will come back down as markets do open up. And also remember, there's two bits to building a house. There's the material you use, and then there's the people at the end of a hammer banging nails or putting bricks together. We don't have a lot of tradies. A lot of the talent that underpin construction in Australia are new migrants. They're migrants, the migrant community. That hasn't been coming in. So this all artificially, I would say, increased or accelerated the cost to build or the cost in order to maintain infrastructure expansion. That'll probably temper a little bit. Fuel's expensive at the moment. I must admit, I don't really fill my tank up that much because I sort of don't do a lot of driving. But I did the other day, and I was like, I scratched my head and went, gee, that sounds expensive. And I looked at the actual board and I went, wow, I can't ever remember seeing petrol at that rate. So some things are driving up inflation. Some things are reasonably stable. Now, a big sort of catch-all of all of this is obviously job growth and unemployment. Fundamentally, if you want a job in Australia right now, you could probably go and get one. Despite COVID, it just depends the type of work you want to do. And not everyone can do all the glamorous jobs. There's a lot of jobs that need doing. So if you want a job, you can get one. Hence the reason we need migration. But one of the big what ifs still is wage growth. And that's been relatively flat for some period of time. But they reckon that's starting to wobble a little bit upwards. And that will change a lot of things in terms of inflation as well if Aussies have more money in their back pocket, Lachlan.
Absolutely. I think last numbers I saw on that was around 1 to 1.5% wage growth, which is pretty much where it's been for a number of years. But absolutely, I saw an article in one of the major publications yesterday, and it was a particular law firm was giving every staff member that wasn't a partner a 15% pay rise, every single one. And I've seen other articles of 10% rises for everyone. And it's there's definitely a noticeable push. But I think a lot of that as well is being driven by talent or lack thereof. And, I'm talking, I guess, from the more white collar professional perspective. There's a well-known and recognized there's a massive shortage of lawyers, accountants, people that have those sort of professional skills. And that money is needing to be thrown to keep people, especially now the borders are open. People can freely go over to the UK or the US or wherever it is and take on much bigger salaries and things like that.
Well, Australia's highly invested in making sure we keep those people here, right? And, that maybe they've got to get paid a few more bucks. And that's just natural market economics will drive that forward. Where I think the biggest challenge is in wage growth is the more structural areas. And there, I think, your background, the ADF, right? Very structured in terms of how do you get more money? Well, you need to get a promotion or do longer. And then there will be a literal, that's a 2.78% increase to your salary. To manufacture more money, more structured public service orientated jobs, whether it's state or federal, is a lot harder. Whereas in private enterprise, I think that will be the fuel for wage growth moving forward, because that is how you're going to keep people. Now, to the point about structurally sort of engineering the growth of the nation, a lot of people in the public service, I think, Lachlan, will be attracted out of it and into corporate Australia because you probably make a few more bucks. And I think that's a bit of a problem moving forward.
Yeah, definitely. I mean, I don't know, when I was in the military and then when I was working with public servants, I think both sides, because they're not under an award, but I think it's a collective bargaining agreement sort of type situation. It was, for as long as I can remember, it was like either 2 or 2.5% each year, which, is fine. And it's great to know that you've got that coming up, and that's nice and healthy to have. But particularly right now, like we're just saying, when you've got some places that might have 10% or 15% sort of growth, as well as potentially higher salaries for a same or similar type role anyway, you're right. It's going to be really hard to keep people attracted. And I mean, I guess from a property perspective, that can be really good. If you're an investor and you're sort of sitting in your job thinking, tapped out of my borrowing capacity, I want to invest more, I certainly want to be a bit more strategic in what I'm doing, maybe you do look at changing job and get those increases and you can get that next property. And
that's all available to you to go about doing it. Everyone's talking about this sort of great resignation at the start of next year about people who just go, well, I'm not happy with this, I'm going to go find another job. That means everyone's just going to shift jobs, which is a headache, but it's also potential. But I think, largely it's a bit of a myth. I think particularly in Australia, where we have such good working conditions comparative to other parts of the Western world and America, for example, you get a lot less holidays and it's a lot more restrictive. I think if organizations provide flexibility to their workers and job growth, wage growth, largely you should be buttressed about it. But this is all sort of microeconomic stuff, but, it may play a factor in lifting the official cash rate. And remember, that's what the Reserve Bank says the cash rate is. Banks usually use that as a clue to working out whether or not they can push your rate up. And I'll tell you what, on the way down, they're reluctant to change their rates. Guess what? On the way up, as soon as the RBA says there's an increase, guess what's going to happen at the banks? They do this merry dance to see who's going to be the first to move, and they probably all get on the phone to each other and just go, what are you going to do? What are you going to do? When are you going to do it? As soon as one moves, everyone moves. So fast on the way up, slow on the way down. So expect that to happen. What do you reckon these changes in interest rates, what sort of impact will there be to investors, Lachlan?
Well, I mean, if we're just being blunt about it, realistically, it means that you're going to be paying more. Like at the end of the day, that's probably the really simple explanation is as the rates go up, people are going to pay more. But I think on a bit of a deeper level, borrowing capacities, they're going to reduce because assessment rates for people to buy new properties, they're going to go up. So you're going to have less at your disposal, to go and invest in more property. But I think as well, it's also important to keep in mind that it's not like rates are going to jump up 5% overnight, and it's not like they're probably, I don't want to be that person that people come back to in 5 years' time when I say this, but, I don't see that they're going to go up to 15 or 17% like they did, back in the 90s. They'll probably end up sitting whenever they get there in the sort of, 5 to 7% range, wherever that ends up falling out. So it's not like we're talking ridiculous numbers here. But I think it's important to understand that, that it's going to become harder to invest. It's going to get harder to get a really good return. So it could be really important for a lot of people out there to sort of think about where they're at today, because if you can borrow what you can borrow today to invest, maybe it's a lot better to take advantage of that now. And as you said right at the start, best time to invest is today, so that, you don't miss out, because I think there'll be a lot of people who will sit on their hands and these changes will come in and they'll go, all right, ready to invest. And then the bank's going to turn around and say, sorry, we can't, you've lost 50 or 100K capacity. You can't do it anymore. And with the price growth we've seen, good investable markets might now be out of reach for those people.
So loaded question then. Does that mean these potential increases in rates, that property isn't a smart investment?
Oh, I definitely would not say that. I mean, ultimately, one of the big benefits of property is leverage anyway, right? The ability to use a small amount of your own money and then leverage with other people's money or the bank's money. And that whole benefit doesn't go away. If you spend 100K and you buy a 500K property or whatever number it is, and you're getting growth on that 500K, you're going to be a lot better off than you are, doing that in other investments where you're only returning what you put in. So I definitely still think property is a really smart investment. You just have to be a bit more careful the way that you're going about it. It's where the days of these 1.5% or 1.8% interest rates that people are on right now are probably not going to be here for much longer. So you have to be strategic about what you do.
And what you do as an investor is key. And let's sort of crack into that. We'll just go to another break. Be back in a moment. Stay with us.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. Now, Lachlan, you're a military man. I know you penned a book recently as well with your partner, also military. I think she's still a reservist and you're ex-military. Is that how it's framed? Yeah, we're getting a nod. And one of the channel, probably you at Duntroon? No.
Australian Defence Force Academy.
Yeah, at ADFA, right? Like I'm sure in your learnings down there doing your academia, you probably come across the term VUCA, which is a military term, volatile, uncertain, complex and ambiguous, which explains the environment that many military practitioners operate within. And they embrace it. And it's a doctrine of discipline that is instilled in military operators to be able to get by in environments that they might not necessarily be able to control. So volatile, uncertain, complex and ambiguous. And I would probably classify the property market as VUCA at the moment. Absolutely volatile. Property's going north at a rapid speed. Who knows if they're going to continue? What's the U again? Uncertain. No one knows where it's going. Complex. We spoke about complexity at the start of the thing, and ambiguous. Like, it's just one of these sort of grey things where you just go, shit, what's happening? So, how do you actually operate effectively in this environment, in this really complicated market?
Well, there's a few things that I think are really important when you are trying to, exactly like you said, get by in this sort of complex environment. I think first and foremost, you need a plan, right? It's gone are the days where, if they ever did exist, which I'm not sure that they did, but gone are the days when you could panic buy, or it was better to, the old saying of like, it's better to be in the market than not, and you just sort of throw money. If that was ever acceptable at any time, certainly not anymore. You've got to have a plan. And by that, what I mean is, when you go to invest, you've got to know why you're investing, what that investment is going to be doing for you, and how it's going to help you get to whatever point that you want to get to. And you've also got to understand why you want to invest, say, in that location. And I know that might sound obvious to a lot of people, but it's going to be more important than ever, because the way that I say things, we're moving back to an environment where it's going to be really important that economies are strong. Like, for example, if you invest in a regional area, you want to make sure that it's strong, because as rates rise and as other things happen in this environment, you don't want to be somewhere where there's a lot of uncertainty in that environment, to use your VUCA saying. So I think that that's really important. The plan is everything, because otherwise you don't really know where you're going, right? You could be buying anything and it could be sending you in the wrong direction for what you need. So having that plan is the first and most important thing. And I think in that plan, you've got to plan for that worst case as well. So what I mean by that is, if rates do rise to 5 or 6 or 7 or 8%, put that into your spreadsheet. And if you don't have a spreadsheet, shoot me an email and I can send you a spreadsheet. You want to know what it's going to look like, because today you might be 5 or 6K in the positive, but when you throw a couple extra percentage points on top of where we are today, you might be 5 or 10K in the negative. And that's going to impact a lot of people. So doing that analysis is going to be key.
Yeah, and you've got to do the analysis yourself. Guess what? The banks will do it for you when they're assessing whether or not you can borrow money. And one of those big things around those APRA changes, that for those that aren't familiar with it, the banks have been assessing you at about 2.5% above the actual interest rate that they give you. So if you've got a 3% interest rate, they're assessing you at 5.5. What APRA has said to the banks, hey, you need to add another 0.5 on top of that. So rather than assessing you at 2.5, it's at 3%. So you've got a 3% on your mortgage, you're getting assessed at whether or not you can afford it at 6%. So guess what? The banks do it for you. That doesn't mean you can outsource responsibility for it. So you've got to plan for that worst case scenario and doing the analysis around it. You shouldn't overcook it so you become obsessed with it, or it negatively impacts the way you approach building your portfolio. But the smart investor, the mature investor, has a good relationship with it, right?
Yeah, absolutely. I think that's a really good point. You definitely don't want to get into that bucket where, you're in that analysis paralysis type situation where you've got so many numbers going and so many thoughts and you just do nothing because you're paralyzed by what's going on. Definitely not. And that's certainly not what I think is a good way to go about it. You just got to understand what's going on. You just have to understand your risk. You just have to understand your reward. And then once you understand those two things, you'll be able to make a really good and informed decision.
Yeah, absolutely. So talking about informed decisions, what do you look at over the next sort of 12 to 18 months when you're evaluating investments, Lachlan?
Well, I think going back to what I said earlier, you really want to understand that area that you're going into. It's not so bad if you're in a capital city, because you're going to have a lot of resilience around, if you invest in Sydney, even if you invest in, say, the western suburbs of Sydney or the south of Sydney, you're still in Sydney, right? There's a big economy there. But it's going to be really important if you do start to look at regional areas and things like that. But I think it's also really important that you just start to maybe start to monitor markets that you might be interested in, because the data, I think, is going to be really important over the next 12 to 18 months. And if you start to look at it now and monitor it now, you're going to see those changes. And some of those things, are, days on market, really good indicator of demand in an area because it's how quickly properties are selling. If you can start to monitor it now, you're going to get a good idea of, okay, people still have really healthy demand in this area, or no, people aren't so interested anymore, even though it looks really good today. And that's going to be really important because, as most people know and most people do it, property investing is a long-term thing. It's not you're not meant to try and make your gains in a year or two. It's not meant to be something that's like spinning the roulette wheel at the casino. It's long-term. So you've got to invest from that perspective as well and monitor your markets and the locations to be able to help you achieve that properly.
Yeah, I completely agree. And for many investors, if they've been at it for a little while, I think the secret is building out these buffers to protect yourself, but also having, a good sense of your portfolio and selling or rebalancing it over time to extract, those properties that have done the heavy lifting for you. Maybe it's time to sell them and move on and repark that money elsewhere in a different asset to go again. How do you sort of go about doing that, Lachlan?
I think the first thing you said is just fantastic. Buffers. It's going to be really important for now as well. I mean, the last thing people need is to be really on the cusp of what they can do. They're making a decision, and then, some of these changes that we've been talking about today happen, and you've got nothing there to protect you, right? And it's something that we always talk about, but I think it's going to be really important just from a risk mitigation perspective moving forward. But the monitoring of performance of your current investments, I think is absolutely critical. I reckon that, I don't want to put a number on it, but I think well over 50% of investors out there that have more than one property probably sit there at night thinking, I wish I didn't have one of these, right? Whether it's one of their 2 or one of their 5 or whatever it is, they think about that. And it's no secret, we're in a great market right now nationally, which is very uncommon because usually it is a bit more discrete with some locations up and some down and some flat. But if you do have that property and you really don't think that it's worthwhile keeping, and you've done all your numbers on it, and you just, however you've arrived at your conclusion, maybe it now is the time, because best case, you get to walk away with a little bit of investment success. Middle case, you make your money back. You've lost a bit of time, but, no harm there. Or worst case, if you've had a really bad investment, you can get the best case of removing your losses, cut them, and then move on to something better. Again, going back to what you said, best time to invest is today. So if what you have isn't performing, let's move it on and let's get to the next thing.
Absolutely. That's insightful, Lachlan. Thanks for your time, mate. I always enjoy chatting. You're working through all the way up to Christie. You're gonna take some time off. I know market's hot and probably investors are banging down your door. You're going to be able to have a break, or you're going to work through?
I think we'll definitely be working through. We've got, like you said, demand is hot. Lots of clients want properties. Lots of future clients getting in touch each day. So no, I think we'll be working through for most of that Christmas and New Year period.
How are people finding you these days? Is your book sort of generating some interest? I know.
Yeah.
I sort of had a good look through it. You flog a few copies?
Yeah. Oh, absolutely. We've been shocked. Maybe makes it sound a bit better than what it was, but we've been really, really happy with just the amount of people who have bought a copy through us or pick one up at the Dimmicks or whatever, and they're getting in touch. And even people who just send us an email and say like, hey, you said this in your book. Can I pick your brain about it for 5 minutes? And you just end up in these fantastic conversations. It's been one of the best things I've done, and getting some of those emails from people as well who might not necessarily be in a position to buy right now, or they're just trying to increase their learning. And just hearing how it's impacted them and their journey, it's been the best part of it.
Is your particular flavour for it? You've channeled your military experience with the lens of a property investor. Are you attracting a particular type of person who sort of comes from that particular bent, or you've been invited down to Garden Island here in Sydney yet to have a chat with some of these young sailors to say, hey, don't blow all your money on shore leave, don't buy cars and jet skis, actually put your money inside property?
No, not yet. Maybe that'll be on the cards next year. But I mean, in terms of people, really, it's a wide variety. I mean, we certainly love helping out people who are in their early stages of their portfolio, or maybe don't even have a portfolio. They're fantastic. But it also goes up to the people who are sophisticated that might have multiple or high value, because I guess just that people really like the way that we look at it and take that military approach, take that data and analytical focus, and then also overlay a healthy bit of common sense. I think sometimes that's a bit lacking out there. So it really is a wide variety, definitely.
No, good one, mate. Well, it's happy to hear it's working out for you. And thanks for coming on the show. We'll see you again, no doubt, at some point soon.
Absolutely. Thanks for having me, Phil.
Nice one. That's Lachlan Biddle. He's director of Atlas Property Group. Remember to go and check out smartpropertyinvestment.com.au, Smart Property HQ on social. That's how you like to get your information. A quick favour for me, and I don't think Lachlan's done this yet, so I'll see it no doubt tomorrow. He'll leave a review, and he will ask every single person also who he talks to leave a review, whichever podcast player you're tuning into. It's just like myself here. Great talented team behind me who do all the heavy lifting, make me sound good. They get a real kick out of those positive feedback coming through those reviews. Yeah, I hope you enjoy that, guys and girls. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Looking to secure finance to maximise your returns on your investment property? Finny can help. With access to over 70 lenders, Finny can find the right finance for your unique situation. So whether you're ready to refinance for a better rate, improve your cash flow, release equity to grow your portfolio, or are looking to find the right finance for your next purchase, we're here to help. Visit finny.com.au today to learn more.